Hi there, everyone, and welcome to this edition of On Track. It's the 27th of April, Anzac Day week as I record this on a drizzly morning in Noosa. Interesting times, certainly a lot going on, which I'm going to unpack today. But firstly, the usual warning, this is designed for clients of McGregor Wealth Management, particularly those that are using our care investment methodology and portfolios. To all else, welcome to listen, but please seek out advice before you act on anything we talk about here. I'm going to cover the economic news. It's all about interest rates as a spoiler alert and what that means for interest rates / inflation and what that means for share markets and property markets and the strength of the economy. So that's the dominant conversation at the moment. And we saw the RBA pause last month. So for the first time in a long time, we've got 2 months of the same interest rate. So the cash rate being 3.6%. Yesterday, the monthly inflation numbers came out for Australia at 6.3. So we've seen that steady fall now. We see the same thing in the US, the steady fall. It's not coming down rapidly, but it is coming down, which is a good thing. 90-day bank bills, which is equivalent of about a 3-month term deposit. Pretty steady over the last few months, about 3.7. 10-year government bond yields are starting to steady in the threes. We'll talk more about that. The Aussie exchange rate has been fluctuating a little bit, but around the 67 cent mark, and mortgage rates have followed the cash rate. The cheapest I can see is 4.99. There's not many there. Macquarie, which is very competitive, is 5.29. And the 1-year term deposit's about 4.4. I should point out the variable rates that we're seeing from the big banks for people that haven't renegotiated or set up their loans recently are up around 6.7%. So anyone who's got a mortgage with any bank, actually, it's not just the big banks, check what rate you're paying, and you should be able to renegotiate with them into the fives. And if you can't, you should be talking to us and we can introduce to people that can help you get rates down. On every $500,000, 1% is $5,000. So it's real money. So interesting chart here that shows what the market, the implied policy rate. So this is what the market is showing. So that's showing very much a pause continuing. And then it starts to show the next step as being down with potentially a 50% chance of a drop in just before Christmas. So that would be on the optimistic end. Maybe it's after that, but that's what the market thinks at the moment. So that's the best estimate from all the money that is in the market, and that includes Australian and overseas investors. So it's hard to argue to beat that. There's a lot of diverse opinions out there, but happy enough to watch the market predict it. It'll change. It's all, as the Reserve Bank keeps talking about, it's all predicated on data. If the data keeps showing falling inflation, then that will help. And we've got this good news, bad news cycle, which I've talked about occasionally. So unemployment is remaining low. Now we go, that's good news, isn't it? Surely. But it is good news because we haven't got more people unemployed. But it's kind of bad news because it means maybe we're not slowing down the economy enough to reduce inflation. And maybe they're going to have to stay high for longer or even put rates up. So that's the good news, bad news paradox at the moment. So any good economic news is potentially bad news for interest rates and vice versa. So if unemployment went up, well, that sounds like bad news. It might actually be good news for rates falling. So it's a weird time in the cycle, and it's hard for everyday investors to interpret, why has the market gone down when we had good news? Or why has it gone up when we had what looks like bad news? One thing with interest rates steadying, it's steadied property prices around the country. We had the first month in quite a while where property prices rose slightly, and no states were falling. I'll share that data shortly. And you'll hear talk in the lead up to the budget on the housing crisis. This is a genuine crisis. Rental vacancy rates are at record lows. I'll show that data shortly. And that means it's hard for people that are renting to find places, and they're competing. So rents are up strongly, even though property prices are down. And at every level of the market, that's creating angst. Suburbs that were once highly affordable become unaffordable, and it's an issue But the workers in picture places like Sydney and Melbourne, if workers can't get affordable housing, then it makes it hard for business as well. There's lots of solutions being thrown around. The Greens just want governments to spend lots of money on housing, and the government probably needs to do some of that, but history shows the best solutions come where the market gets incentivized. So with the budget coming up, there's always this talk of, should they get rid of negative gearing? But they probably need to entrench it there, because they need to encourage investors to be investing in more housing. And they probably need to be encouraging some form of tax benefit for changing dwellings to be multi dwellings. So taking a 4-bedroom house, turning it into two-bedroom apartments, that type of thing. Because what's happened over the last 40 years is the number of people living per house is dropping. So once upon a time, the average was higher than 4. These days, it's dropping below 2 and quick. There's lots of people that live by themselves. So that alone makes the demand for smaller housing increase. And obviously, there's a lot of couples, normally baby boomers and older, who are sitting in 4 to 5 bedroom houses they've had, that obviously don't go a long way towards solving this. Lots of discussions will be had, lots of political bias will come out, but probably a good combination of a little bit of government providing for those that really can't find housing in the cities, like housing commission type stuff, but smarter, combined with some incentives. We'll see what happens. It's a big test for this government. So let's keep clicking through. Returns for the month are fairly modest. That's for March. Markets have gone up strongly in April. So when we come to the charts, you'll see that. So well and truly up. And these returns are to the end of March, 5-year returns, just a fraction under where we'd like them to be. The 7-year returns are well above our long-term targets. And the 1 year, as I said, pretty flat to negative, with the exception of the active portfolio, the reserves, and the Aussie share portfolio. Our view, market's just a fraction above fair value. We kind of have fair value around 7,200, 7,300 for the ASX 200. And that's not, whenever we say fair value, that's not, this is where it must trade. Markets fluctuate around with new news all the time. At the moment, the thing that drives markets in the long run is profits. In the short term, it's news. So it's the profits that come through from companies that will determine the long run. But we think, it's still in that fair value range. And the real danger, as always, is when markets are at extremes of fear and FOMO, which I'll talk more about, but we're not there at the moment. So the good news, bad news, and the news cycle. So the hot news topics for this year, as we've talked about, inflation, interest rates, profits. So that pushing up of interest rates, what might that do to company profits? What might that do to the economy? Russia, Ukraine, still going on. We tend to forget about it every now and then. China and China, US, we've got the US politics and the fiscal cliff. That's where the ceiling, the debt ceiling, self-imposed by both sides of politics, will be hit this year. And we'll see shenanigans between the Democrats and the Republicans, all about show ponying. It's an election year, so that has the risk of creating some short-term volatility. We know how it plays out in the long run. Eventually, both sides agree on lifting the debt ceiling, because otherwise public servants don't get paid. But that will come up. The media will jump on it when it comes up and make it sound like it's a real big crisis. And don't get me wrong, while it's something that needs to be navigated, it's probably not going to change things for the long run, which is what we're interested in. Extremism, we've talked about catastrophizing everything. And as always, black swan, that's unexpected events that we haven't even thought about, which, like COVID, which are rare but can come along. Last month, no real change in any news, except that inflation's lower, but the amount of the drop was largely expected. So we had markets recover, but they've kind of paused at the moment, looking for direction and data on where we're going with interest rates, etc. And as I repeat, everything is in the price. So every opinion around the world is in the price. And for anyone who wants to trade short term, they've got to be smarter than the overall market, and they've got to be able to execute perfectly. Very hard to do. We make no attempt to do so. We just make sure we invest well into the market, a little bit of downside protection, the occasional tweaks on rebalancing and trying to avoid trouble spots is the main thing that's led us to have really good returns through troubled times. One of the biases, and we talk about these biases every time because they are the driver of long-term returns. Most investors fail to get the returns that their investments get because they mess with it. So in the long run, the evidence is quite clear. Investors only get about 70% of the returns that would be available if they just left their investments alone. Makes a massive difference. One of the biases is overconfidence. We all think we have more ability to predict and act on information. And as I said, all that information is in the market. And the studies are really clear on this, and they show that overconfident investors, overconfident traders trade more. And as investors trade more, they make less. So there's overwhelming evidence and studies on this. And this is on the averages, of course. There'll be occasional people that get that right, but very rare, very hard to do. And the evidence keeps coming in all the time. One of the reasons for this is because in most areas in life, if there's a crisis, if there's a problem, you've got to do something. We've all heard the terminology, don't just stand there, do something. In the market, it's not the same. Markets react really quickly. So when we get something like a COVID or a war or some new economic news, the markets respond almost instantly. So by the time we're thinking about what to do about it, it's too late. Markets have fallen. So in markets, it's not don't just stand there, do something. It's don't just do something, stand there. Unless you are got the crystal ball and we're able to predict these events in advance, which no one actually does. So long-term, avoiding volatility, which we talk about endlessly because it is so important. Once again, the last 20 years is such a good illustration of the wall of worry, the slow and steady climb of the share market, but punctuated by periods of worry where markets drop. And the big one right at the start, which is nearly 20 years ago since the last boom started. We defined that boom or the FOMO was where the market's doubled in the last 2 to 5 years. At the moment, it's taken 9 years for that to double. So that makes the likelihood of a big drop very low at the moment. It would take a black swan event of some significance. And now, it doesn't mean we can't have 5, 10, 15% drops. They're extremely common, as we see here. But the big ones, as we've talked about a lot, tend to only happen after a boom, and we're certainly not in that position at the moment. Rates are everything. I've kind of made this chart a permanent feature of this presentation because it shows where we've been. We've got all these years of falling interest rates, and then the ultra low rates that were emergency settings during COVID. That was the life support to get the economy going, to get people investing. And then we had to come out of that because it worked. Economies came back strong and inflation started to appear, so rates started to go up. That's short-term rates. These are the long-term rates. So the yield curve, the top charts here, shows rates right out to 30 years. So if you're investing in long-term government bonds, they'll give you, in Australia, just under 4%. In the States, a fraction lower. But 10-year bonds, which is where most of the bonds are issued, at about 3.4%, as we said. So firmly in that band, that dropped a long way in the last 6 months. That have come from upwards up around 4%. We're starting to see this steady. So potentially that's our new normal. We're trading range somewhere between 3 and 4%, which at least adds a little bit of predictability. Now, we can't say they're going to be predictable forever, but at least we're seeing some steadiness there. These yield curves, and it's interesting how in Australia we've got this short-term dip in shorter-term rates, then a rise. In America, it's the opposite. Now, some people say this bump up in short-term rates that we see in the States shows them heading for a recession. And often when there's a recession, we've had this inverted yield curve, as they talk about it. Not every time, but often. And it is quite likely the US is engineering a recession to squeeze inflation out of the system. It's highly probable it's a very shallow and short recession, but it depends on so many other things. And just to put recessions in context again, a recession is just where the earnings of a country drop for 2 consecutive quarters. So if we equate it to a person, and that person earn 100,000, a shallow recession would be the equivalent of them getting a pay cut to 99,500 for a couple of months. And it wouldn't bother most people. Whereas a deep recession, like the US had during the GFC, was the equivalent of a pay cut of 10%, 100,000 down to 90,000. They're rare and don't happen very often. Most recessions are shallow and short. Well, we'll see one if there's a recession in the US. I don't think it matters too much for the longer term markets, and markets normally bottom in a recession. And historically, if you'd bought during a recession, you would have done well over the next 10 years, every single time. So because interest rates start to get lower, it cleans out the system. So recessions are on the bottom. As shown here with all these vertical blue lines in the index chart, which show that anywhere you invest in that vertical blue line, 10 years later, you've done extremely well. So investing in recession works really well. Hang on through recessions is almost the only way to do that, besides throwing more money in. If there is a recession, where a process comes into its own, quite clearly in the wall of worry. We see these big downturns once again, all of them except for COVID came about after a boom, and all recovered extremely well. The mess it up, which is the ways that people use those, or fall victim to those behavioral biases. We sort of have this mess it up. I don't think it's an acronym, but the letters, I forgot what they call that, someone will correct me, that talk about the different ways that people do that. So the one I'm focusing on today is under diversification. There's a tendency for people to fall in love with one hot area. I once had someone come in and say they were just going to invest in lithium stocks, because lithium stocks for the future, electric cars and batteries, and any strategy that just is that specific is highly dangerous, and highly volatile as well. So trying to pick the perfect winner, and we see this with tech. You know, the tech story is often really good, but tech investing can be highly volatile. It goes through strong periods of growth, but then massive corrections as well. And we do have a core belief that diversification is the simplest and best way to get long-term investing. It forms one of our 3 pillars under modern portfolio theory, so around about 3 attributes: asset allocation, diversification, rebalancing. And this stuff works extremely well when you manage all the other bits, managing our behavior as investors, not messing it up, learning from history. So that's understanding that cycles and volatility is inevitable and normal, and that we can't time it, so it's long term, and above all, plans that are based on your own situation. So let's have a look at the Aussie market. And you can see on the chart on the right here, we had a very the 1 month figure for the Australian shares in March was almost neutral, but we've had quite a solid upward from the lows that we had during March, and that came about as data got better, as it looked more likely that the RBA would pause, and they did pause, so we saw an increase. But right now the market's just come back a fraction, and it's kind of waiting to see what happens next. So it's looking for data. That data could be good profit reports, that data could be continued falling inflation, and good economic news that would cause the market to resume upward path. And keep in mind, when we do get good economic information and profit updates, that increases the fair value of the market as well. So we might see the market go up, and we might say it's still fair value because there's been new news that shows that companies are growing well. The diversification that we just talked about, amazing diversification, we get any exchange traded funds that we have. So this is BAS, and it's the long-term growth there. This is the growth of $10,000 over 10 years if the money's reinvested, and up to 2.5 times over 10 years, a very, very good return. And the diversification achieved with, this is just the top 10 companies, but you effectively own 300 companies in there. So see all the usual suspects. US shares, so global leaders, which is IOO, which we hold in the active portfolio. So it's the big end of town. It's Apple, Microsoft, Amazon, Google, really big companies. It's had a really good 2023. So from the bottom of the market there in January, up really strongly. and very strong over the last 10 years, $10,000 to 42,000. Now, part of that return, so that market has averaged, about 15%. Apologies, the flags and the way that's 14.96 over 10 years. But 1/3 of that return was due to a declining Aussie dollar. So exactly the same investment held in the US has achieved a 10% return, which is bang on the 100-year average. So once again, I think markets are just a little over fair, not a whole lot, and they're sitting on their 50 to 100-year averages, not in any crazy boom territory. Small caps, US small caps, once again, a reminder, they're pretty large by Australian standards. And you can see the massive diversification. This is the top 10 holdings, and ironically, their cash is the number one holding at 1.92%, but the next one is 0.62. So this exchange traded fund, ETF, holds literally thousands of stocks. So, and that is incredible diversification. It has also had a spectacular run over the last 10 years. But once again, normalized for exchange rates, it's averaging about 10% in its native currency, being the US. And look at the difference in the chart between this one and the previous one. And this is why diversification works so well, and it gives us opportunities to rebalance. So in the long run, both of these things have done really good, but they're moving slightly differently. So when we get a month like this, where IOO is up strongly, but other areas are flat, we will rebalance there. So we'll sell a little bit of IOO, we'll buy a little bit of this one, and that rebalancing adds value. The academic research shows between 0.5% to 1% per annum. We believe we've achieved that from rebalancing, which kind of pays for the whole process and keeps it extremely cost efficient. So emerging market shares is the toughest one over the last 10 years. Still done all right. So it's still doubled over 10 years with everything reinvested. But over the last 5 years, extremely flat. And that's because there's been a bit of trouble in the emerging market world. We had COVID, which impacted emerging countries a lot more. Think Brazil and things like that. But then we've had the Russian crisis. There are no Russian companies left in emerging markets anymore by choice of the providers. We've also got China and some of the political unrest and instability and fears about them messing in the market. But we think emerging markets is a great long-term play. It always outperforms in the long run, but it can go through more turbulence. And you'll see the quality of some of the companies here when we look in there. You've got companies like Samsung, which most people know, and that's from South Korea. So South Korea is considered an emerging market, a very strong economy. Chinese companies like Alibaba, Tencent, Taiwan Semiconductor, which makes the chips that go into most of our computers. And the world is vastly diversifying away from Taiwan in case there's any unrest there with China, because we all learned during COVID that when chips don't ship around the world, it holds up supply chains in everything these days. There's chips in absolutely everything. So then we look at gold. Gold had a big run up during March. So the monthly figure was up 9%. And that was partly, it's hard to always tell with gold, but often it's when people are worried about things like inflation, but also political unrest and instability. And gold, after being surprisingly subdued for most of the year, has bumped up a little bit. We keep gold as an insurance policy. It doesn't produce any income, so you can't have too much of it, but it does go up nicely when the rest of the markets are down, as we saw last month. Property cycle is alive and well, represented by the two models we have here of the sort of the long flat periods followed by short, sharp, upward, rapid rising, and then settling in for long and slow, and represented by the property plot, which I'll show you where we're up to in a minute. So I left this slide in from last month because it's really important. It shows how much interest rates, this is in the blue line, is the standard variable mortgage rate, how much it impacts property prices. So when you look at periods where interest rates are falling, it often coincides with risings, but more importantly, when you look at periods where the market has been falling, so the red line is the average of the capital cities, prices don't start to go up till interest rates start to steady and drop. So you'll see that time and time again, these purple highlights where prices going down, they start to go up again when interest rates drop. And often they'll go up pretty strongly. So as much as we're feeling cautious about the property market at the moment, with interest rates pausing, there will be opportunity. When we look around the traps and some of the numbers, we can sort of see residential property in the capital cities. And this chart shows the vacancy rates, which I talked about earlier, record lows. So vacancy rates in the normal range would normally be in the 2% to 3%. So we've got in some cities, we've got this record low, 0.4%. That almost means there's not many properties available. They're only coming up and they're being snapped up really quickly. And that's in Perth, massively low vacancy rate. Part of the reason we think Perth properties are going to continue to do well, but low across the board. The highest one here is in Canberra at 1.8%, and that's not a high number. Like I said, 2 to 3% is normal. What this has led to is the rise of rents. And you'll see that happening all around Australia with rents rising very strongly over the last 12 months. And you'll see that compared to, and look at Perth, which is the black line here. We saw rents actually falling for years and years. That made it affordable and rising again now. And Perth did go through an oversupply hangover from the last commodities boom, 2004 through to 2009. And that resulted in sideways price movement, which has now given opportunity. So the monthly change, top left-hand corner here, every capital city was up over the last month. That has meant, we can pretty much say that the market's paused and turned a little bit, and that's turned right in, as the interest rates were paused. We still see with 10% down across, or 8.5% down across the capital cities. Adelaide and Perth are up for the last 12 months. So investors there haven't seen any downturns on average, of course. But there's a difference between, and I find this chart on the bottom left really interesting. So it shows that the movements in prices across the whole country, so the averages across all the capital cities, and the top end, the top 25% price-wise of properties have done it much tougher than the low end, so the bottom end. So the more affordable housing has been steady. It isn't down by as much, and it's 130% up on pre-COVID prices. Top end of town is 110% up, 109%, and the middle 50% is 118% up. So all sectors have done well, but compared with the peak back in about July of last year, the top end of town and the mid section are down, and the low end fairly solid, because there's this battle for affordability. And as rents go up, a lot of young people are saying, well, if rents are up, let's have a crack at buying a house. Now, yes, interest rates are up, but yeah, there's certainly been an influx in the first home buyers and younger people upgrading. This chart, same time frame, back to pre-COVID. So it shows the experience in different capital cities. So if you could rewind the clock, you would have loved to invest in Adelaide just before COVID. And then Perth and Brisbane have also done well. Sydney and Melbourne less so, and that's because the bigger cities had a tougher experience during COVID and a longer time to come out of it. Hobart, Canberra, Darwin, all up about 25% as well. So this was a catch-up time for the smaller capital cities, where Melbourne and Sydney often lead the way, and then the smaller capital cities catch up. And it's just pure affordability. If Sydney's average is $1 million, which is pretty close, Brisbane's always going to be somewhere between 60 and 80% of that in its median value. And the same with Adelaide and Perth. There was a time back in 2009 where Perth prices were ahead of Sydney. And when you look back, you go, wow, that was never really going to stay like that in the long run. There's a natural order there. Part of it is land availability. The smaller cities have more room to grow compared to Melbourne City. But I haven't got any slides in this month, but population growth will continue in Australia to drive the property market. To fix rates, the decision is not as clear as it was a few months ago, when you'd be saying don't fix rates. If we look at the chart on the left, you can see that fixed rates are steadying and variable rates have gone up. So the variable rate on average, as from our friends at Mozo, 6.09%. So all of a sudden, and you see there the big four variable rate, 6.66. If you're with the big four, you've got to be ringing them up. You've got to be keeping them honest, because otherwise they will steal your money, literally, by not offering. And they're offering to new clients 5.79. So, but their existing clients, they let it drift to 6.66 on average. So nearly 1% that they are stealing by not passing on those offers of the lower rates. Now, if you ring them up, they'll probably drop it instantly. But it is, and it's, the flip side is for all of us who are investors, it flows back to us in bank profits. So it's a careful what you wish for thing. But back onto should you fix or not if you've got a mortgage. 1 year fixed rates at 5.77, all of a sudden they're lower than the variable rate, although I would suggest you can find lower than that in variable. My tendency is not to fix at the moment, but that discussion is always around affordability and predictability, not so much predicting what the market's going to do, but for some people, they just want to know what their rates are going to be so they can budget effectively. So all of a sudden, 5-year rates at 6.42, it's not that far above the variable rate. So for someone that wanted certainty, let's say they were buying an investment property, and if the cash flow worked at 6.42, you lock it in. That gives you 5 years of rental increases before you've got to worry about it. Now, rates might drop. That market chart I showed right at the start shows rates dropping back somewhere around Christmas either side to about to back around 3.25. That and if rates start to drop back into that pre-COVID levels of about 1.5 to 2%, then we may see mortgage rates settle back in the fours. So caution on whether to fix or not. Very particular about your own circumstances and your own strategies. So if you want to talk about it, just talk to one of the team. We can certainly help you if you find you're with an institution that doesn't want to renegotiate. There's plenty that will. The property clock from our friends at Performance Property, who help us find properties for clients who it is part of their financial plan. A few changes. They actually wound Sunshine Coast back a bit, which says they think it's probably still got a bit more to go in this shorter term cycle. Sydney's come down a bit more, but it's starting to get into the flat period, stagnation, where it's not moving, which we saw before. Still got Perth in the value from the blue chips, and the blue chips are the main capital cities and within a 2-hour drive. In the second tier, the triple B, places like regional Western Australia got close, and country Queensland, Cairns, Mackay, Rocky. My preference is not for smaller regional towns. That's my personal preference, just because there's more volatility. I'd rather be in places like Brisbane, Ipswich at this stage of the cycle, but certainly Perth and within 2 hours of Perth for those that are comfortable further afield. That's pretty much it for today's episode, and ending as always with just reinforcing our process. Exciting life and borrowing money is what we believe you should have. We do these updates just to give you some perspective on the media, but we believe all investing should be done as part of a real plan where there's goals based on you and who and what's important to you. Portfolios designed to meet those goals. We take a long-term view. All the boring stuff, diversification, asset allocation, liquidity, and low-cost index for most growth markets. And we protect against that volatility, which is inevitable, with enough reserves for our retired clients who are drawing down, dollar cost averaging for our wealth building clients who are still working, and rebalancing regularly. And there is only 3 ways to lose money when you do it properly. And that is panic and selling, having to sell, and not properly diversified. And we try and make sure our clients don't do that. And we haven't had anyone panic and sell through this whole last crisis, which means our clients never have to sell good assets at a bad time, which means they get the benefit of the long-term rise eventually. Thank you as always for your time. Appreciate you listening. As always, yell out if you've got any things that you want us to talk about in these things, or any suggested extra information. We try and keep them reasonably short. I know we've got some people that could listen to more detail, but others who prefer short and sharp. So thank you, and till we talk again, Rob McGregor signing off.